All right, welcome to The Explainer. Today we're going to talk about how financial markets really work. We're going from these old school ideas about perfect, rational markets all the way to the insane, computer-driven, high-speed reality we see today. So let's start with a really simple question that's actually at the heart of one of the biggest debates in all of modern finance. This question pits brilliant investors against these super powerful theories, and believe me, the answer has shaped how trillions of dollars are invested. So yeah, let's dive right in. Okay, so here's the plan. We're going to start with that classic perfect market idea. Then we'll look at where it kind of falls apart. After that, we'll get into a much newer, more dynamic theory, one that sees markets as more of a biological ecosystem. And finally, we'll see how this all plays out in the wild world of high-speed algorithmic trading. All right, first up, we've got to start with this foundational concept from economist Eugene Fama way back in the 1960s. And this wasn't just some small idea. It was a powerful theory that totally changed the game for how people thought about investing. So the core idea here is actually pretty simple, but it's also elegant. It goes like this. If all the information out there, every earnings report, every news headline, every single forecast is already factored into a stock's price, well, then there are no bargains left to find. It means trying to beat the market isn't skill, it's basically just gambling. Now, for this theory to actually hold up, you got to imagine a very specific kind of world. A world where every single investor is like a supercomputer, right? Perfectly rational, processing new information in a blink. And in that world, if a stock is even a tiny bit mispriced, bam, it's corrected almost instantly, which means there's just no way to make a real profit from it. Okay, what's interesting is that this hypothesis isn't just a single idea. It actually comes in 3 different flavors, each one a little more intense. First, you've got the weak form, which says looking at past price charts is useless. Then, semi-strong takes it up a notch, saying even digging through all the public financial data won't give you an edge. And then, there's the strong form, the most extreme of all, which says that even if you had secret, illegal insider info, you still couldn't consistently beat the market. Wild, right? Okay, so that theory is super clean, super elegant, but reality? Yeah, it's a whole lot messier. For decades, both researchers and real-world investors have been finding all sorts of evidence that markets just aren't that perfect. And that, of course, brings us to the big challenges to this whole idea. And here's the thing, the crucial point really is that markets are made of people. And people, well, we're not always those perfectly rational, calculating machines that the theory needs us to be. We have biases. We get caught up in hype and fear, right? And all that emotion can create very real, sometimes very long-lasting hiccups and inefficiencies in prices. And it gets even more complex than just our psychology. Let's say you are a perfectly rational trader. You spot a clear-as-day mispriced stock. Even then, real-world stuff can get in the way. Things like trading costs or the risk involved or just not having enough cash to make the trade. All of that can stop you from fixing that mispricing. And the result? The inefficiency just hangs around for a while. So this all builds toward a new way of thinking, a new theory that tries to bridge the gap, right? It's trying to connect that clean, rational world of the original hypothesis with the messy, emotional reality we actually live in. And that brings us to the adaptive market hypothesis. Now, this theory throws out the simple yes or no question about efficiency. Instead, it suggests the level of efficiency is always in flux, always changing. It asks us to stop thinking of the market as a perfect machine and start seeing it for what it is, a competitive ecosystem, like a jungle, with predators, prey, and a constantly changing environment. And this table just lays out that huge shift in thinking perfectly. On one side, you've got the old theory, EMH. It sees this rigid, static world with rational robots and almost no opportunities. But on the other side, you've got AMH, which sees a living, breathing, dynamic world. A world where behavior evolves and profit opportunities are kind of like animal species. They show up, they thrive for a little while, and then they get competed into extinction as everyone else adapts. Okay, so if markets aren't perfect and these little windows of opportunity open and close, how do traders actually make money from them? Well, that leads us right into the world of quantitative strategies. These are trading methods built from the ground up on the ideas of that adaptive market hypothesis. This is the world of statistical arbitrage, or stat-arb for short. Now, forget trying to predict a company's next big product. This isn't about that. This is all about the data. The whole strategy is based on a really simple but powerful idea. Prices might wander off on their own for a bit, but sooner or later, they tend to snap back to their historical patterns, like a rubber band. So, a classic way to do this is something called pairs trading. It's pretty straightforward. First, you find two stocks that usually move in sync, like best friends. Think Coke and Pepsi. Then you just watch and wait for them to fall out of step. Maybe one zigs when the other zags. When that happens, you make your move. You bet on them getting back together. You buy the one that's underperforming and you short the one that's overperforming. That's just a fancy way of saying you're betting its price will fall. And then you just wait for them to make up and get back to normal. But here's the catch, and this is what really proves the whole adaptive market idea. These profitable little tricks, what the pros call alpha, they don't last forever. The moment a trader finds a good strategy, other people notice. They pile in, and pretty soon that opportunity is completely competed away. That advantage, that alpha, just decays over time. And that forces traders to be on a constant hunt for the next new thing. And this constant, desperate hunt for an edge that's always disappearing, well, it's led to the ultimate battlefield in modern finance. It's a full-blown technological arms race where victory and defeat are measured in tiny, tiny fractions of a second. Yeah, forget the old trading pits with people shouting. Today, the dominant players aren't even people. They're computer algorithms. And their number one weapon? Pure speed. There's this term, latency, which is just the delay in processing data. And let me tell you, firms spend fortunes to shave off every single possible microsecond. Why? Because being the absolute fastest to react to new information, that's where the new alpha's hiding. Just to give you some perspective, 350 milliseconds. That's how fast some of these trades can happen. We're talking way, way faster than the blink of an eye. This kind of insane speed means these algorithms can see new information, like a big government economic report, and execute a trade before a human brain could even process what it's seeing. So let's bring it all back. What does this crazy, high-speed, adaptive world actually mean for that question we started with? Can you beat the market or not? Well, what the evidence seems to show is that the market really is an evolutionary battlefield. The profits from these lightning-fast trading strategies are definitely real. But, and this is the key part, as more and more competitors jump into the high-speed game, those profits are already starting to shrink. It's exactly what the adaptive market hypothesis would predict. The ecosystem is adapting in real time. So if you take one thing away from this, it should be this. The whole debate has moved way beyond a simple, yes, markets are efficient, or no, they're not. The reality is, markets are not perfectly efficient, but they are brutally competitive. Efficiency isn't an on or off switch, it's a constantly moving target. And the game itself is just this endless cycle of finding a new strategy and then everyone else adapting to it. Which leaves us with one last thought to chew on. In this huge, complex financial ecosystem, survival of the fittest is all about the ability to adapt. The high-speed predators that are dominating today might not be the ones on top tomorrow. And that forces us to keep asking, what new species of strategy will evolve to dominate next?